Hello again. Mervyn King only has a couple of meetings left as the Chief of the Bank of England, but will he leave the UK with one last blast of QE? Well, I've been speaking to Chris Beauchamp from IG Markets. What is there left for the Bank of England to do? Because there just seems to be some sort of consensus that QE can only do so much. So is the emphasis now going to be on schemes like funding for lending?
I think a lot of that is the case. QE has not run its course entirely. There's still space for it, but I think a lot of the impact of that has now worn off. So they'll be looking at more unconventional policies. Now, we know the Chancellor is very keen on shifting the emphasis for growth policies onto the Bank of England. We've mooted out in the budget. Possibility that they might expand the funding for lending scheme and try to give it an extra boost to widen the impact, give the British economy an extra boost. But really, I think the Bank of England rather finds itself tied in what it can do. We know it can't really cut interest rates because they're record low. Inflation continues to run at a fairly too high a pace, really, for their taste. And also, I don't really think they can weaken the pound anymore. We know Mervyn King tried that before and he talked about it at the beginning of the year. But of course, if you weaken the pound, it boosts manufacturing, but it hurts consumption, and that causes a problem for the UK economy.
So what are the expectations for Mark Carney? Because they do seem to be, I don't know about mixed messages, but mixed expectations for him. He does seem to have this Superman image that he can come in and resolve the UK's problem, but he's already warned about the limitations of his powers. So what do you expect when Mark Carney takes over?
He's already been very careful not to sort of boost expectations too much about what he can do, so I don't expect any major changes immediately. Of course, I think his problem is that the main problem in the UK economy is that its main trading partner, the Eurozone, is still suffering in the depths of recession and the crisis, whereas in Canada you have a big trading partner form of the US that is recovering, albeit slowly. So Carney will have that difficulty. In addition, there's not really much he can do in terms of QE or the interest rates. We know the Bank has sort of reached the limits of conventional policy. So a lot of it is expectation management, I think. He won't want to suggest that he can suddenly restore the UK economy. We know that inflation in Canada is much lower, so he does have a good track record in that sense. But I think the problems are rather more different for Carney now. Yeah, and don't the MPC meeting minutes show that really the committee is against more QE, at least in the short term? Exactly. We know that despite this sort of late surge for some more QE from some corners of the MPC, the vast majority of the committee would rather we don't change policy. And of course in Canada it's rather more of a consensus policy, so I think Carney will look to try and drive the opinions of the committee in different ways to slowly move them in a direction of a change in policy, if indeed he wants to do that at all. He may of course rather look to boost it in other ways. So I know you follow the FTSE very closely, and we're in the midst of earnings season in the UK. If we pick out some highlights, how are the banks doing? We've seen RBS return to growth, and also HSBC perform very strongly. So how does that translate into what we might call the real economy? Well, I think it's a good sign clearly that RBS and HSBC are seeing improvement across the board. RBS especially of its implications for the UK government stake in the bank. Not just the banks though, I think a general improvement. Sainsbury's been reporting seeing a boost in sales at the moment, and other companies seeing really just slow improvement. I think that's the element to take through. What we know from the US, of course, is that margins remain at fairly high levels, so there has been room at least for companies there to squeeze margins in order to keep profit doing well. And the same thing could be said of the UK, that companies looking to sort of, and they're sitting on large amounts of cash, but they're looking to cut margins in order to retain sales at current high levels. Yeah, we're seeing the equity markets run away in the US. The Dow's broken above 15,000, S&P breaking new highs. FTSE as well just seems to be keeping on going. Surely it's getting this rally's going too far, isn't it? Well, if you look at it, sort of 1,800 points since the summer low, so yes, you might say the market's being overextended, and it wouldn't be surprising to see a weakness creep back in. But look at the broader macro environment. The US economy, those non-farm payrolls were excellent. We also have easing from central banks, the ECB, the Australian Central Bank, even Norway and Poland as well, cutting rates. So there's a slight easing bias as well for central banks. So if you combine those two elements together, yes, markets have had an excellent run, and we wouldn't be surprised to see a weakness. But the underlying theme of conditions being positive for markets hasn't really come to an end yet. Well, Chris Beauchamp from IG Markets speaking to me there. Later this week I'll be having a currency conversation with both Miles Eakers from Savvy Trading and Craig Erlam from Alpari. But for now, goodbye.